Thanks very much, PMS Bazaar, for inviting me again. This is, I think, my second or third time here. Each time I see the turnout getting bigger and bigger, which shows greater interest in investing in India in particular. When they asked me for a presentation topic, I said that everybody's going to talk about India per se here, at least most of them. So I want to just talk about more conceptually about the way I have looked at markets for 25, 30 years. We all grew up in a very good part of India's growth history from 91 onwards. But in that period, it's never been a straight line up situation. It's been up and down all over the place, and a lot of global macro events, good and bad, have happened in that period. So what I'm going to describe here is the way I have figured it out for myself as to how to understand cycles better. It's only one component. It's a more complex series of models that I have built over time. But I'm going to talk about the more simplified version of it, at least one part of it. At the end, I'm sure you'll have many questions, but I don't think we have room for questions, thankfully, because I don't think the questions are going to be very polite. So let's get into it. So investing is, in my view, there is a surface game which we all understand, and then there is an inner game. And here what I'm going to talk about is the inner game of investing. What really lies underneath the surface of what is talked about, good companies, bad companies, P ratios and stuff like that. Is there a larger method and a mechanism at work here? And that's something that I will describe over the next few slides. So this is my lake of returns theory, which it came to me while looking at the .com boom and then the bust there. It was a very short boom, like 2.5 years or so. And it came to me that the way markets appeared to be to me was like a giant reservoir or a lake in which you have a finite amount of returns available for every conceivable traded asset class, even non-traded ones actually. And it was like almost a pictorial way to look at markets, and that's how then I started to formalize this thinking. That has helped me a lot, stood me in very good stead in the last 25 years since I actually conceived of this idea. We'll start from India. And we all know India's normalized returns over 35, 40 years have been around 14, 15%, give or take a percent here or there. Let's start from the foothills of the journey of the Indian stock market. From 1982 to March 1988. And this is you can call it a dam reservoir. On AI could not find anything better. So this will have to do from a pictorial perspective. But I think it does the job. The CAGR of returns from India was 9.4%, which was below what we now know was the trend. There was no trend then, of course, because the Sensex itself was barely born a couple of years before. But we know that 9.4% for India almost at any point in time for a country with inflation running at about high single digits or low double digits most of the time. 9.4% equity returns simply don't cut it. So I would classify that as a low return period. And then from 1988, which by the way was when I just finished MBA and came back to India, so the timing was good. When I entered actually the financial markets, when I joined Citibank, 1988. I actually joined them in April 88, to be honest with you. And the market just took off, and it compounded at 81% for the next 4 years, which was the culmination of the Harshad Mehta bull market as we popularly know it to be. And you can see that the water levels, which is the return levels, went up dramatically, which is basically a pictorial way to look at the 81% returns over the 4 years. And this is annual return. And then the lake dried out completely over the next 11 years. We had a CAGR of only 3%, which is minus. So the Sensex levels that were reached in 1992, I don't think were taken out till 2000. It was a pretty much a lost decade from a stock market return perspective. So again, you can see there was an overflow of returns in the 1988 to 92 period. The lake filled up, overflowed, and then the water levels receded to -3. Let's keep going. you can see that what's interesting is that when you look at the entire returns for the market from January 1988 to March 03, the whole period, it normalizes to 14.5% CAGR, which is exactly the return we now know India is supposed to deliver as an asset class. So between the boom and bust, the market eventually normalized the entire excess returns to hit a number of 14.5% 15 years later. So there is a pattern to markets, there is a method to markets. Markets are not random at all, as you will see more and more data points coming. And then again, we now know the era from 2003 to 2007 was unbelievably good for a lot of people in this room. That was the first time when they really saw markets up close in a very good way, because dot-com time was still premature. Most of the people here are much younger, than us old fogies. That period was a compounding of 49-50% over 4 years. It was massive. And I remember sitting in the December of 07 in my office with my two analysts who work closely with me, and I said, this market is an absolute short. Because this lake's capacity is 14-15%, and it is now filling up, it's filled up rapidly to 49-50%. There has to be an overflow of gargantuan proportions. And then came the crash of 2008. So in fact, the main reason, and I was known to be the big bear back then, I called it out publicly back in December 07, January 08. Many of you people might remember me from that time. It did not come out of a stroke of genius or anything. It came out of this analysis. It's pretty much that. There were other pieces, of course, but this also formed a very central part of my thinking that this market is done for. And then, of course, we saw between those years, it was markets fell 60-65% in 1 year. It had a CAGR of 50.8% negative. So the lake receded again rapidly. And then from March 09 lows, it started to fill up again to 21% CAGR all the way to March 15. Okay, so again the lake levels rose up to something well above the lake's capacity. Now, the interesting thing is, after that, from March 15 to March 20, which is the point up to which the COVID pandemic broke, the returns were just 1% CAGR. Now, the interesting thing is, in the preceding period, which was the 9 to 15, the returns were 20%. They were not phenomenally high. They were not the 40s and the 50%, which is why in the remaining period, there were no negative returns. It was just a very flattish market overall on a point-to-point basis, barring the intermittent rallies, where it returned just a 1% CAGR, okay? And then, recent COVID, and the Sensex lake of returns level expanded to twice the lake's capacity. So basically, April 20 to September 24, which was the recent market peak, the Sensex CAGR was 26%. We know the Sensex can deliver 12, 13, 14%. Lake levels filled up dramatically all over again. For the small caps, the lake levels are well beyond its capacity. So the long-term returns from Indian small caps is in the range of 18 or 20%. This lake, this time around, in the last 4 years, returned 48%. That's the kind of returns we have seen from the lake of returns from the small cap market. So Sensex, again, 2 times its capacity. Small caps, again, 2 times the capacity. Now let's go to the US market. The same story repeats, and I can go to all over the world, but let's just focus on the 2 principal markets that are of interest to us. The lake of returns theory in the US market shows a very interesting things as well. Again, go back to July 1921 to August 1929, CAGR of 23.4%. Again, probably, I don't know the data of expected returns 120 years ago, but 100 years ago, but it might have been maybe 7, 8%, 6%. The returns were 4x the normal water levels in the lake, okay? And then, for the next 25 years, the returns were precisely 0. Because of the overflow, overflooding, it was complete and total mayhem. For the next 25 years, the CAGR was 0. Again, 82 to 87, which is when Warren Buffett Bill Gross of PIMCO, all of them started to make their careers as brand names. They were helped in no small part by a massive bull market that started in 1982. Again, for the next 5 years, CAGR of 25%, well above the capacity of the US lake, which is around, let's say, S&P 500 should deliver you 8 or 9% CAGR. It delivered nearly 3 times that for the 5 years. And again, the lake levels depleted rapidly in the period from 87 to 90. That followed, of course, the period of the crash, the Black Monday or Black Friday, I don't know what it was, in 87. The CAGR fell to half the lake's capacity in the US. And then, of course, something which some of you might be familiar with, the big tech boom in America started. It was unbelievable, started in 94, ended at the top of the market, March 2000, a CAGR of 25%. Again, lake levels, you can see, rose to over flooding levels. That's when I actually formulated this concept in my head, because it just came to me pictorially that this is nothing but a giant lake which keeps depleting, keeps filling up. If I just catch at the point of over flooding, I think I'm going to become very, very rich. And I caught the peak precisely again because of that same reason, that the lake looked well beyond its capacity to deliver those kinds of returns of 25% CAGR. Okay. And we know what happened thereafter. For the next 3 years, the returns were a negative 17%. It was mayhem, complete and total destruction. Stocks fell 90%, stocks got delisted, stocks don't exist today what existed as hot stocks back in the year 2000, whether in India or even in the NASDAQ. And then the lake started to fill. Of course, I just want to make one caveat here. The lake filling in America was a lot slower than what happened in emerging markets. This was the only period, if you go back in history, that emerging markets substantially outperformed US markets. This period of 2003 to 2007. Otherwise, over a 35-year period, the emerging markets have never beaten the US markets, barring this blip of 2003 to 2004, which is why the lake of returns speed of filling up is a more moderate 14%, while for a market like India or even Brazil, they were growing at 40, 50% in this. As you saw in India, we grew 49% CAGR in this period. American lake was filling up a lot slower. The US dollar also, believe it or not, was a terribly weak currency in these 4 years. Today, it doesn't seem like the US dollar was ever weak. US dollar was extremely weak back then. People may or may not remember, but the Indian rupee strengthened all the way to 39 from, I think, 47, 48. Imagine, Indian rupee strengthened 20% against the US dollar. Again, most people will not believe that happened, but Dinshaw, my dear friend, will obviously remember that period. So strange things have happened in markets. This is just giving you a sense that the US market was not so dominant permanently as we believe it to be, or the US dollar so. We had a period in the middle in which it was a pretty weak market relative to EMs. So was the US dollar as a currency relative to most emerging market currencies. And then came the GFC crash. So again, same thing, what I showed you in the Indian slide, markets lost 43%. And you can see that came COVID, and from April 20 to Jan 25, the CAGR has been 19%. Again, you can see the lake levels receded dramatically after GFC, then again started to fill up, and from the period of the COVID onwards, it's been blowout. I mean, US markets returns should have been 7-8% normalized. They returned 2.5 times that number in the last 5 years. It's massive it's a massive overflow by any standards. And the NASDAQ, of course, is another world altogether, 21% CAGR in the same period. We know the Big Fang or the Magnificent Seven or whatever names they are called with, have driven these kind of returns for the US markets since the COVID. Now, given the visuals of the US lake of returns, as we stand right now, what do future levels look like? Any guesses? Dinshaw? Okay. So here is what this is my prediction, and if they call me back after 5 years, you can hold me to this. Here's what the next 5 years will look like for the US lake of returns. So the S&P 500, so US market lake, 8% is what we would expect rationally from the US markets. Current level is 6120. In order to achieve this 8% from the start of the bull market for a 10-year period, the next 5 years returns will be minus 1.8%. And for NASDAQ, again, slightly higher returns expectations, it would at best be a flat NASDAQ 5 years out. With one caveat that there will be, obviously it will not be flatlining like that of a dead patient. You will see volatility as we know, but from a trending market, we have gone into a trading market. You know, and this number that you get at the end of 5 years will be a number which might be reached plus minus a couple of percent here or there, but I would be very, very, very surprised if the number is beaten on the upside. It could well be beaten on the downside, meaning the indexes actually have negative returns for this period. I think, in my view at least, this is a very optimistic forecast for the next 5 years for the US market. Okay, last 4 slides. Come on. People who expect the, okay, let me get a show of hand. People who expect the Sensex to deliver from here till, okay, let's say it's 75,000 today. Let's say a 15% CAGR up to 2030. How many people expect that? Okay, good. Clearly you didn't understand the presentation at all. Okay. So the Indian lake of returns, let's go with the small, the Sensex. Expected rate of return is 11%. Now why, you would question, why were you looking at a lower number? Because the government itself is now projecting a nominal GDP growth of about 10%. And the 15% comes at a period, most of the returns of the Sensex have accrued in periods where nominal GDP growth has been around 14-15%. So by and large, the returns from India are going to mirror the nominal GDP growth. So if the government itself is projecting 10%, I think we can only estimate it to be 1% or 2% more than the nominal GDP growth, not the 15% that we have been used to in the past. So if you project based on that, you're looking at a 2%, in my view, best case return from the Sensex over the next 5 years. This is an overflow Sensex. The lake of returns from the Sensex are at overflow levels. Again, and by the way, in small caps, it's the same story, probably worse than that of the Sensex, where you're going to see the long-term growth for the small caps is 18% CAGR, but again, in line with what I'm talking about in Sensex, I will reduce this similarly to 15%. You're looking at some small cap level 5 years out at 38,900, which is a decline of 3% from the current levels on an annualized basis. These are projections which I think can be probably beaten again on the downside, but definitely not on the upside. The lake of returns for the Indian stock market is full. It is at overflow levels. What you're seeing right now in the markets is exactly the phenomenon of the lake of returns overflowing. This is not a lake which is semi-full or dry. Close to the brim, when you know, again, I've given you 30, 40 years of history in a very short span of time, you know what happens thereafter. So this is not idle research. This is not some theoretician or PhD scholar writing a thesis. I have acted on this consistently over the last 25 years. And just 2 months before the Indian market peak, I'll show you a little visual. This is a tweet that I put out. And it said, "Hai koi Michael Lal who can give a fixed guaranteed return product yielding 10-12% USD returns to an FPI? Send full details." The date is 17 July 2024. The market peak happened in September 2024. By August, I had got fund managers who were giving me very decent, averaged out 11-12% US dollar fixed returns, guaranteed returns. I moved a lot of my capital out of both the US and India, in particular in India, into fixed income. So using the same lake of returns theory, so far, the trade seems to be working out very, very okay. Thank you very much, ladies and gentlemen. That's my presentation for the day.